Welcome back to the vlog. We're gonna jump into chapter 4. All right, so we're gonna jump back into chapter 4, gaining critical advantage from indicators. Okay, indicators give you the edge. If you had inside information about a company's earnings ahead of time, market players would say you had an edge or advantage that allowed you to trade profitably on that information. A poker player who can read the other player's hands from their facial expressions has an edge, as does the blackjack player who can count cards. Technical analysts perceive indicators as like the inside information edge. Indicators give you an advantage by identifying upcoming price moves that not everyone can see. Indicators are the technical analyst tools. For a formal definition, an indicator is a line or set of lines that you put on a chart to identify chart events, chiefly whether the price is trending, the degree of trendedness, and whether a trend turning point is being reached. The purpose of indicators is to clarify and enhance your perception of the price move. Every trader wants to buy low and sell high. You use indicators to gain an edge in doing exactly that. As I note in chapter 1, the technical approach has two components, or rather forecasts, or a rational forecast based on probability, and a trading plan that always contains the price point at which you'll exit with the most tolerable loss, avoiding the risk of ruin if your trade goes against you. Classifying indicators. Analysts like to categorize indicators in many different but equally valid ways. Some like to put indicators into one of two buckets, such as accumulation, which is bullish, or distribution, which is bearish. Another classification method is indicators for trendedness, indicators for trend momentum, and indicators for volatility. Although you can classify indicators a dozen different ways, I prefer to boil it down to the following. Judgment-based indicators. Judgment-based indicators. This group includes visual pattern recognition methods such as bar, line pattern, and cycle analysis, as well as candlesticks. These indicators can be time-consuming to master and to use, although nowadays software will do the interpretation for you. Okay, math-based indicators. The math group includes moving averages, regression, momentum, and other types of calculations. Expressing chart events in mathematical terms allows you to backtest the event over historical data to discover how well it predicts the next price action. You may prefer to jump straight to math-based indicators because they're faster, cleaner, and scientific. But math-based indicators do the same job as judgment indicators. They display price data in a specific format to assist you in making a trading decision. Just because they're based on math doesn't mean that they aren't subjective. You determine the specifications of math-based indicators in the first place, such as how many days are in a moving average. Visual recognition and math-based techniques are equally valid and useful. Some traders use only visual recognition techniques, some use only math-based indicators, and some use both. Remember, the use of math doesn't confer a crown of authenticity on any technique, and you may discover that visual recognition can work just as well as fancy indicators. If math isn't your cup of tea, don't worry. The math involved in most technical analysis isn't that difficult. You can apply math-based techniques without understanding the math behind them, as long as you understand the crowd behavior that the indicator is identifying and how to apply the indicator. Think of it as knowing how to drive a car without being able to rebuild the carburetor. Understanding what indicators identify. In chapter 1 and 2, I point out that securities prices are sometimes trending, they have a strong direction bias, and that trends are punctuated by retracements or small moves in the opposite direction before the trend resumes. At other times, prices go sideways, called range trading. Finally, trends end, and after they end, they may reverse to the opposite direction. So indicators identify 5 conditions. Note that in this list, I put some suggestions next to each condition, but someone else could name other equally valid indicators. A trend is beginning, moving average crossover or pattern breakout. A trend is strong or weak, momentum, slope of linear regression. A trend is retracing but will likely resume, relative strength index. A trend is ending and may reverse, momentum, moving average crossover, or pattern breakout. A price is range trading, slope of linear regression, or moving average. Each indicator works best in one situation and less well in others. Technical traders argue the merits and drawbacks of indicators in each situation. And if you ask 10 technical traders to list their top indicator for each task, you'll get 10 entirely different lists. Most traders use a fixed set of indicators and try to remember that indicator 1 is pretty good at validating rising prices, like the moving average, while not so hot at identifying an impending reversal. For that, they may prefer indicator 2, the MACD. Traders don't identify conditions and then apply an indicator. They leave the indicators on every chart and expect to remember how to rank reliability under changing conditions. Yeah, so next time we'll look at choosing your trading style and finding relevant time frames, examining how indicators work, convergence and divergence, and establishing benchmark levels, as well as a bunch of other stuff. All right, thanks for joining. See you guys next time. Peace.